If you still think the $10,000 bank rule is about criminals walking into a branch with a duffel bag, you are using a 1970 map to move money through a 2026 surveillance grid. That is how ordinary retirees get into trouble. They think they are making a normal withdrawal, a normal deposit, a normal payment to a contractor, a normal gift to a child, a normal transfer after selling a car or cashing out a bond. What they do not understand is that the rule did not really stay still. The number stayed still, the machinery around the number did not, and that is more dangerous. I have spent my life looking for places where human beings keep reacting to the visible thing while the real force sits underneath it. In markets, that hidden force is often incentives. In business, it is often the structure. In banking now, it is the tripwire. That is the line I want you to hold in your head. You are not moving money through a simple banking system anymore. You are moving it through a tripwire system. Every transfer, every large cash request, every awkwardly sized deposit, every payment that looks ordinary to you but unusual to a machine can touch a wire you never saw. And once you understand that, you stop behaving like a person casually handling money. You start behaving like the operator of a financial flight deck. That identity shift matters because most people over 60 are still acting as if the old world exists. They think the bank is there to follow their instructions. They think the government only cares if the money is dirty. They think breaking a payment into smaller pieces makes life easier. They think digital apps are casual and cash is formal. They think documentation is for businesses, not for ordinary families. That is exactly how the tripwire catches them. I want to walk you through 5 parts of this system because once you see them clearly, the fear goes down and the control goes up. The first tripwire is what I call the frozen gate. In the old mental model, you walk into a bank, ask for your money, prove you are you, and the transaction happens. In the new model, unusual activity can trigger review before release. Older customers are under heavier scrutiny because financial institutions are under pressure to detect elder financial exploitation. That sounds noble. And in many cases it is. Real abuse exists, real scams exist, real theft exists. But here is the practical consequence. The system is now rewarded for caution. If your behavior suddenly changes, if the amount is larger than normal, if the purpose sounds unusual, if the bank senses fraud risk, delay becomes the safe institutional choice. They would much rather slow down a legitimate customer than release money into a scam and explain it later. That means your timing can break even when your money is legitimate. A man thinks he is buying a car for cash. The bank thinks he might be under pressure. A widow thinks she is wiring funds to a roofer. The system thinks the pattern resembles exploitation. A retiree thinks he is simply taking out cash for a family wedding. The branch sees a deviation from years of smaller withdrawals. This is not really about right and wrong, it is about asymmetry. The institution pays little price for being overcautious. You pay the price when your transaction stalls at the exact moment you need it. The second tripwire is the structuring snare. This is where common sense gets people hurt. An ordinary person looks at a rule and says, "Fine, I will just stay below the line." A machine looks at that same behavior and says, "Why is this person trying to stay below the line?" That gap between human instinct and regulatory logic is where the danger lives. The law does not just look at whether the money is legal, it looks at whether the pattern suggests you were intentionally trying to avoid the reporting framework. That is why clean money can still produce ugly consequences. A person can be moving the proceeds of a home sale, insurance money, pension withdrawals, or family savings, and still create a problem by slicing transactions into neat little pieces that look designed to dodge the system. I have seen this pattern in business my entire life. People think they are being clever when in fact they are stepping directly into the shape the system was built to detect. If you truly need to move $12,000, the foolish move is often to send 6 and 6 because that feels less visible. In reality, that can look more intentional, not less. The retiree thinks he reduced risk. The algorithm thinks it found motive. Never forget that. In a compliance system, artificial neatness looks worse than honest size. The third tripwire is the digital funnel. People still separate the world into real money and app money. that separation is fading. Digital asset reporting has become much more formal. Broker reporting on digital asset sales began with transactions in 2025, which means crypto is no longer living in the shadows. In the way many amateurs still imagine, payment platforms have also become a tax document problem for people who treat every incoming app payment as casual. The old threshold drama around Form 1099-K confused millions of people. But the real lesson was simpler than the headlines. The government wants more of the commerce layer documented, categorized, and matched. The careless person hears that and says, "So every dinner reimbursement is taxable now." That is not the right conclusion. The right conclusion is this: personal reimbursements and true family transfers are not the same thing as payments for goods or services. But you are now living in a world where sloppiness creates paperwork. Paperwork creates mismatch, and mismatch creates pain. If you use one payment channel for selling items, another for hobby income, another for split bills with family, and you do not keep the categories clean, eventually you will have to explain a mess that you created by treating record keeping as optional. The digital funnel does not usually punish people because they are criminals. It punishes them because they were casual in a system that stopped being casual. The fourth tripwire is the merchant file. A great many retirees still think, if the bank does not report it, the transaction disappears into private life. That is fantasy. The other side of your transaction increasingly has its own incentive to document you. Businesses that receive large cash payments have filing obligations. Car dealers, contractors, professionals, and other merchants do not look at your large payment and think, "How can I protect this customer from disclosure?" They look at it and think, "How do I protect myself from penalties?" That difference matters enormously. When a business is legally exposed for late, incomplete, or incorrect reporting, it becomes aggressive about collecting your identifying information, classifying related payments together, and filing what it must file. That means the retiree who believes he can break a transaction into parts and remain invisible is often just creating more records, not fewer. One roof, two payments, same project, same paper trail, one car, one cashier, S-check, one cash component, same reporting logic. The system is not a single toll booth anymore. It is a series of linked toll booths. The bank may see you, the merchant may see you, the tax form may see you, the database may link the events later. That is why I say the old idea of keeping things simple by keeping them quiet has become dangerous. Quiet behavior is no longer necessarily quiet. It is often merely undocumented from your side while being documented from everyone else. The fifth tripwire is the inflation squeeze. This is the one that ties the entire story together. The most dangerous thing in this whole subject is not some brand new law. It is an old threshold living in a much more expensive world. The $10,000 line was born in a very different economy. Back then it was a large amount of money. Today it is the size of many normal life events. That means the system did not just expand by passing more rules. It expanded because everyday life rose into the altitude where old thresholds now sit. A car purchase can touch it, a remodel can touch it, a medical event can touch it, a family gift can touch it, a maturing instrument can touch it, a retirement distribution can touch it, a property transaction can touch it. So the average retiree is not brushing up against this world once in a lifetime. He may be brushing up against it again and again without even realizing he entered regulated territory. That is what I mean by the inflation squeeze. The threshold did not move. Your life did. Now I want to tell you the part that matters most. I am not interested in teaching you paranoia. I am interested in teaching you operating discipline. Fear makes people freeze. Discipline makes them move correctly. So let me give you the operating system I would use. First rule clear large moves. If I knew I was about to make an unusually large withdrawal, deposit, or transfer, I would not surprise my own institution with it. I would call ahead. I would explain the purpose in plain English. I would ask what format they prefer. I would ask whether a branch note, a banker note, or supporting documentation would make the transaction smoother. I would remove ambiguity before the machine has to guess. That is how adults handle serious money. They do not let a compliance system meet a surprise before a human meets an explanation. Second rule, never create a pattern that looks smarter than it is. I would not split transactions just to feel less visible. I would not play games with the threshold. I would not instruct my spouse to do one part and myself to do another part, just because that feels tidy. The moment your behavior starts to look arranged around the line, you are telling the system a story you may not enjoy later. Honest size beats artificial neatness. Third rule, prefer traceable rails for large legitimate transactions. When there is a proper wire available, I prefer the wire when there is a documented bank. To busyness path available, I prefer it. When a dealer, contractor, lawyer, or title company can accept funds through a clean institutional channel, I want the channel that leaves the most coherent and least confusing record. People love cash because it feels final. They love it because it feels private. They love it because it feels old-fashioned and under their control. In the modern system, very often it gives you the opposite of what you think you are buying. Fourth rule, separate your categories before the government separates them for you. Personal reimbursements, family transfers, hobby sales, side income, business receipts, digital asset activity, large gifts, and major purchases do not belong in one mental drawer. If you mix them, you create interpretive chaos. If you separate them, you create defensive clarity. Clarity is one of the highest return assets in the world. Fifth rule, build your paper trail before you need your defense. Most innocent people do not lose because they are guilty. They lose because they are undocumented. For every meaningful transaction, I want a simple contemporaneous record date, amount, source, purpose, recipient, supporting contract if there is one, invoice if there is one, email chain if there is one, bank memo if there is one. I do not need a legal brief. I need clean memory captured in real time. A good paper trail turns a suspicious pattern into an understandable story. A bad paper trail turns an understandable story into a suspicious pattern. And there is one more rule, maybe the most important of all for anyone later in life. Do not let the system meet you only as an old person. Let it meet you as an organized operator. That is the identity flip most people resist. They keep wanting to be treated the way they were treated 20 years ago. They want familiarity to stand in for process. They want a long banking relationship to substitute for documentation. They want common sense to substitute for system logic. That world is receding. The right response is not anger. The right response is adaptation. If you are over 60 and move real money with any regularity, you should have a transaction protocol. You should know which institution to call. You should know how you document purpose. You should know when you use a wire, when you use a branch, when you use a business payment, when you use a family transfer, and when you wait until the record is cleaner. You should know who your trusted contact is. You should know how your accounts are labeled. You should know what looks normal in your own history and what will look like a sudden deviation. That is not overkill. That is adulthood in a higher friction financial age. The people who get trapped by this system are not always reckless people. Many of them are decent people using outdated assumptions. They think the line is still where it used to be. They think the institution still thinks the way it used to think. They think their intentions are visible. Your intentions are not visible. Your pattern is visible. That is why this subject matters so much. A man believes he is buying a car for his wife. A system sees a late-life customer requesting an unusual amount of cash. A retiree believes she is helping a grandchild. A system sees multiple transactions that cluster around a line. A family believes they are just using apps the way everyone uses apps. A reporting framework sees commerce, gross flows, and mismatched records. This is not really a story about banks. It is a story about translation. Your job is to translate your life into a pattern the system can read correctly. If you fail to do that, the system writes its own interpretation, and its interpretation is rarely built to be generous. So here is the question I would ask myself tonight. If I had to move a meaningful amount of money tomorrow, would my bank, my records, my payment method, and my documentation tell one clean story from beginning to end? If the answer is no, then you do not have a money moving system. You have a hope-based system, and hope is a terrible compliance strategy. I would fix that before I needed the money, not after the first delay, not after the first letter, not after the first flagged payment, not after the first confused conversation with a teller who sees a warning on a screen you never knew existed. The $10,000 rule is no longer the story. The Tripwire grid is the story. Once you see that, you stop trying to be invisible. You start trying to be clear. And in this environment, clear beats clever every time.